Jack Manley, Global Market Strategist at JP Morgan Asset Management. Jack, thanks very much for joining us.
It's good to be here. Thanks for having me.
Stocks at record highs. Do you think there's too much euphoria out there right now?
Not really, frankly. I mean, I think we've been kind of chopping around a little bit over these past couple of weeks, which feels more or less okay. But to me, the thing that markets should be excited about is the prospect for earnings in 2025, and that story is still very much intact. You know, you're looking at wage growth that is slowly but surely moderating. You're looking at inflation that seems to be stabilizing. Rates are set to move lower, so borrowing costs are coming down, and you're already starting to see the evidence from an earnings perspective this year. We think that's going to continue next year. So no, I mean, I don't think we're overly excited right now. I'm not worried about markets being at all-time highs. I'm actually pretty constructive on stocks.
Let's switch to trade tariffs and policy. U.S. President-elect Donald Trump has threatened this 25% tariff on Canada and Mexico. You think it would be pretty clearly illegal under the current trade agreement among the three countries?
As far as I can tell, any sort of unilateral tariff is not permitted under the current terms of the USMCA, which, as a reminder, is the rebrand of NAFTA that happened during the first Trump administration, which means this idea of a 25% tariff on Canadian exports to the United States on day one would be in violation of that treaty and would likely result in litigation. I would assume that this stuff is going to get tied up in court. But beyond that, I do think we have to think a little bit more critically about what tariffs could do, specifically as it relates to Canada, since Canada is such a large trading partner with the United States. You know, we know the USMCA is up for renegotiation in towards the end of next year. The threat of tariffs will certainly be present there, even if they are not actually implemented on day one of this administration. And even if tariffs are implemented on Canada, you know, we think about the exports or the composition of exports from Canada, and the vast majority of those exports are energy products. And it remains to be seen if energy products would be included in that tariff. So, I mean, a lot of noise out there, right? And a lot of news, a lot of headlines, certainly a lot of market reactions to all this stuff. But I still think we are very much in a wait and see mode as it relates to tariffs, in particular as those tariffs relate to Canada.
Sticking with Canada here, you reckon that inflation seems to have been tamed in this country and deflation not a clear and present danger right now?
That's the hope, at least, and that seems to be what the data are suggesting. I mean, for a very long time, there was this concern that the Bank of Canada had done its job just a little bit too well, that high interest rates were squeezing out consumption, that the labor market was softening too much, and that inflation was rapidly cooling. And now that last part, I think, is particularly interesting because elevated inflation was such a big concern that a lot of folks forgot that you don't want no inflation. You certainly don't want deflation either. There is a harmonious kind of balance that needs to be struck here from an inflationary perspective. And once those CPI numbers had tipped south of 2%, all of a sudden, right, there are these concerns. And I think policymakers reflected those concerns. And you saw the BOC come out with a couple of jumbo cuts, right? They've been pretty aggressive in their monetary policy easing thus far this year. But you know, the most recent CPI report out of Canada showed a little bit of a reversal in that. We saw a headline come back to 2%. We saw the core measures move up a little bit higher. All these things were a bit firmer than expected. So the deflation story, at least, has been put on the back burner. But I'm also, to your point, not really that worried about reflation either. You know, shelter inflation, which was a huge and has been a huge driver of inflation, both in the U.S. and in Canada, continued to ease in that October print. The labor market is notably softer than it was a year ago. I think all these things, again, kind of point to this idea that inflation probably is starting to stabilize close to around 2%.
And that would be kind of benign. I mean, that's what they want, 2%.
It's what they want, but if they can figure out how to do 2% alongside a labor market that tightens up a little bit, there's your sweet spot. But if you end up seeing the labor market continue to deteriorate and economic growth continue to cool off, then the 2% number is not going to be the only thing that Macklem's paying attention to. It's another thing that we forget about is policymakers spend so much time unilaterally focused on the inflation numbers. They actually pay attention to other stuff too, right? And just because inflation is now under control doesn't mean that the job is necessarily done. They still need to be mindful of what's happening in labor. They still need to be mindful of what's happening with the overall economy.
So your anticipation is that the next interest rate announcements in both Canada and the US, you reckon the chances are they'll both be modest reductions of a quarter of a percentage point?
I think that's right. I mean, the most recent CPI read in Canada suggests 25 basis points out of the BOC in its final meeting. It is a big week for labor data in the U.S. The October Bureau of Labor Statistics print was extremely disappointing, very modest. We're hoping for a rebound there. If there is a rebound there, then 25 basis points does seem likely for the Fed as well in its final meeting of the year. I think it's next year where stuff gets a little bit more complicated, because as we look at what's going on with the U.S. economy, I think all signs are pointing to an economy that will continue to run just a little bit warm, right? You look at what's going on with inflation seeming to stabilize around 2.5%. You look at a labor market that's still pretty tight. You look at consumption figures that continue to still be quite strong. That likely means, to me at least, that when the Fed puts out its new dot plot at its meeting this month, it'll tell us that they're no longer thinking about cutting rates by 100 basis points next year, that they'll probably cut a little bit less. Meanwhile, the Bank of Canada is going to be paying very close attention to, of course, what's going on with their own domestic data, but also what's going on with policy out of the new administration in Washington. And they will act ahead of time if they need to. And so what we might end up seeing happening, not in December, right, not in this month, but over the course of next year, is a further gapping out of policy rates between the U.S. and Canada. And that is not good news for the CAD, which has very clearly been under a lot of pressure even recently.
What do you think? Are we looking at the loonie dropping potentially down into the 60s?
It is. I would say it is possible, right? I mean, one of the forces that will be driving it, and one of the forces that has driven it lower, is this interest rate differential. And if that continues to gap out, that is net more downward pressure on the loonie. The new complication, right, is what's going on with trade and tariffs, because one of the only things out there that is anchoring the U.S. dollar anywhere close to earth is the magnitude of our trade deficit. And if that trade deficit starts to get unwound even a little bit, and Canada's trade deficit with the United States is quite significant, but the U.S. trade deficit with the world is quite significant. If that trade deficit starts to get unwound a little bit, all of a sudden we are talking about that much more upward pressure on the U.S. dollar, that much more downward pressure on the loonie. So this to me kind of feels like a double whammy that could very easily put continued or lead to continued downward movement in the Canadian dollar over the course of next year.